In an unscheduled press briefing yesterday, RBI Governor Shaktikanta said that the Monetary Policy Committee's off-cycle meet had unanimously voted to hike rates. The rationale behind this decision was the upside risks posed by global factors to India's inflation trajectory. The repo rate now stands at 4.40% with immediate effect. Consequently, the standing deposit facility rate stands adjusted to 4.15%. Meanwhile, the marginal standing facility rate and the bank rate stand adjusted to 4.65%. However, the Monetary Policy Committee has decided to remain accommodative while focusing on the withdrawal of accommodation. This is aimed at ensuring that inflation remains within the target going forward, while supporting growth. Driven by food inflation, the headline inflation number in March had touched 7%. And high-frequency price indicators for April have indicated that food price pressures would persist. At the same time, the direct impact of the increases in domestic pump prices is feeding into core inflation prints and is expected to have intensified in April. Effective from the fortnight beginning 21st May, the RBI has also hiked the cash reserve ratio by 50 basis points to 4.5% of net demand and time liabilities. This is expected to withdraw liquidity to the tune of 87,000 crore rupees from the system. So, how is it going to impact home buyers? Analysts say that this is the beginning of the end of low-interest home loans. According to Anurag Group Chairman Anuj Puri, for home buyers, this hike signals an imminent end to the all-time low-interest regime. Low interest has been one of the major drivers behind home sales across the country since the pandemic began. The rise in interest rates will ultimately impact overall acquisition cost for home buyers and may dampen residential sales to some extent. In fact, the policy decision will impact all loans, from home loans and car loans to personal loans. Let's say you are planning to take a loan. You should act quickly to ensure that the loan is disbursed at the present lower rates. However, this applies to fixed rate loans such as personal loans and auto loans. This won't be of much help for new home loan borrowers because those are mostly floating rate loans. And fixed deposit rates are set to rise. Ideally now, a depositor should consider locking funds in shorter duration FDs in order to enjoy the benefit of higher interest rates in the coming months. We spoke to Madan Sabnavis, Chief Economist at Bank of Baroda, to understand the impact on economic recovery, inflation and cost of credit.
In terms of inflation, it would have a kind of a mixed impact. I see a mixed impact because lots of commodity prices which have gone up are because of supply side pressures, that is exogenous shocks which are being emanating from the global economy. For example, crude oil prices are up. That's a global factor. Edible oil prices are up because of embargo which is there on importing oil from Russia. Or recently we've seen Indonesia has put a ban on export of crude palm oil and RBD. So these are the factors over which actually the Reserve Bank has little control. So will these prices come down? The answer is probably no. But if you're looking at the way in which monetary policy operates, by increasing the rates, you will be able to control excess demand pressures, which will be mainly in the form of fresh investment which is taking place. Because today, if companies go in for fresh investment, there would be a tendency for higher demand to be generated, which in turn could push up the prices of goods further. So with both consumption as well as investment slowing down, there would be a tendency for growth to also slow down. So we at Bank of Baroda earlier had a forecast of around 7.4 to 7.5%. There could be a downside of around 25 basis points. In terms of inflation, we earlier felt it would be in the region of 5.5 to 6%. But given the kind of way in which things have evolved outside, we could be expecting inflation to be around 6% still with an upward bias. It could go towards 6.5 and 7%, especially in the next couple of months. So overall growth may not be retarded significantly on account of the interest rate hike. At the margin, of course, there would be an impact on investment and property consumption. So therefore, growth will be lower than what we had projected earlier, but it will not be more than, say, 25 basis points on the downside. the cost of credit will definitely go up, and so industry will have to pay a higher interest rate. So this is a cost which has to be borne by industry. How significant is it? We have generally seen on an average basis, the ratio of interest costs to net sales or your turnover is in a region of around 3 to 4%. So while definitely it would get impacted, it would not be broad-based. I think only sectors which are highly leveraged, which depend a lot on borrowing, they're the ones who will probably be affected. But on the whole, profit margins will be affected at a margin, but not very significantly, purely on the basis of the interest rate hike which we are seeing today.
For the financial markets, it is now evident that the central bank has finally embarked on the policy normalization process.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.